central banks are saying, I want my gold back. And it's like they want to repatriate. And France has repatriated everything. India is repatriating. Everyone's repatriating. So when they come for their gold, and it isn't there because it sure as heck wasn't there when the Bundesbank wanted it. And in fact, some of that was melt gold. Some of it was brand new bars that were just minted.
The price just collapsed. If you add the 4 days together, total about 12 hours, gold fell $1,000 in 4 days. Now people say, okay, well, that's not a safe haven. Okay, well, if you put that $1,000 back on, gold would basically be unchanged since this war thing began. Say the U.S. revalues it at, just pick a round number, $10,000 an ounce. Could be $20,000 an ounce, whatever, because they look at it as deficit neutral free cash. That doesn't necessarily mean that gold has to trade at $10,000 or $20,000 an ounce the next Monday.
Gold's latest weakness looks less like a broken safe haven and more like pressure inside a strained paper market. The stronger signal is still physical demand, especially from central banks seeking to return metal to national control. Andrew Maguire, a London-based precious metals trader known for his focus on physical flows, and Craig Hemke, founder of TF Metals Report and a longtime gold market commentator, argue that recent volatility should be viewed through the lens of the clash between paper leverage and real bullion demand. The core point is that gold is not changing, currencies are. A $1,000 fall during a few concentrated trading windows can make gold appear fragile, but the broader trend remains shaped by reserve managers, sovereign buyers, and institutions seeking an asset without counterparty risk. If more nations repatriate reserves and question whether stored metal is fully available, the market may face forced buying, higher physical premiums, and a repricing that paper sellers cannot easily control. That makes the sell-offs look more like engineered shakeouts than a failure of gold's role as long-term monetary insurance for serious investors right now. Now, we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you and enjoy the video.
If the central banks and the sovereigns and the institutionals in the real markets, in the physical markets, are buying and exchanging their dollars, pounds, euros as fast as they possibly can to protect their wealth and to hedge that wealth in the only asset class that has zero counterparty risk, then why aren't we all doing it? And this is the question I keep asking people. Why have you cash in the bank? Are you crazy?
Right. You save in pounds and I get paid and save in pounds and I get paid and save in dollars. And we pay our bills and whatever we have left over is our own currency reserves, right?
Yeah.
And what reward do we get for that? The central bank just creates more and more currency, effectively devaluing all of our hard work. Like I'm out here digging ditches and breaking rocks all day. But you get the idea, look, that's what people have, I'm sure, heard me say this before. The gold is the measuring stick. The gold doesn't change. Everybody thinks it's your currency is the measuring stick because we say gold is dollars per ounce and shares are dollars per share. And everybody thinks the dollar is the measuring stick. And that's not true. Gold truly is. It's a pet rock. It's a piece of metal that collects dust and doesn't pay a dividend and all that kind of stuff. But it's the measuring stick. It just sits there. It's static. It doesn't change. It took $1,100 to buy an ounce of gold 10 years ago. It took $2,100 to buy an ounce of gold 5 years ago. It takes $4,300 to buy an ounce of gold today. 5 years from now, it'll take $9,000 to buy an ounce of gold. And then that's why you see the daily, ups and downs and volatility and people, oh my gosh, what's going on here? And it's just like, whatever. Okay, I'll just, if it goes down a little further, I'll buy some more because the math is the math.
It is. And I think this whole narrative that's evolved, that gold's no longer a safe haven asset. Why? And you see Bloomberg, everyone's talking about, they've latched onto this narrative because essentially, I think personally, we all know the WikiLeaks cable. We all know the reason that the COMEX was launched. It was to stop central banks exchanging their dollars for gold, create enough synthetic supply, make it volatile as hell. And so people still question that. And I think, well, just go back and look. I mean, there it is. That was the actual raison d'etre for putting it in place. So you kind of think, well, okay, but how can they still, because they've dug a huge hole. I mean, empirical evidence tells us, Craig, the US Treasury gold isn't 100% there, is it? I mean, it doesn't take rocket science to say, well, hold on. We all know what happened to 2013 and I mean, it's 8,100 tons of gold there, and it's being looked after by various central banks. And the Bundesbank says, oh, can we just come and have a look? No, you can't see it. Oh, okay, we can't even audit. We can't actually just look at our gold. No, you cannot. Well, can we have 300 tons of it, please? It might take 7 years. Okay, so, okay, now, if you turned up at your vault and they said to you, oh, no, Craig, you can't see it. What would you do? You'd say, I want it now. Give it to me, wouldn't you? So, I think what we're looking at here is a situation where the Fed has dug a hole. It's a big, big, big hole. How do you repair that hole?
Right.
And I think everyone may have their different view on that, but I think two things really. They're running out of open interest, enough people to take the other side of their price suppression scheme. They're running out of enough open interest. Whereas it used to be 800,000 contracts down, we're seeing the lowest in almost history.
Yes.
So you kind of wonder, what do you do when it's called in? Because we see central banks, I know it's all, you're all over this story. Central banks are saying, I want my gold back. And it's like they want to repatriate. And France has repatriated everything. India is repatriating. Everyone's repatriating. So when they come for their gold and it isn't there, because it sure as heck wasn't there when the Bundesbank wanted it, and in fact, some of that was melt gold, some of it was brand new bars that were just minted. I mean, and some of it had to be re-refined because it was such poor quality. So what happens when this is a move that's happening now? So they are coming back, they're coming for their gold. Where do they get it? Go to market to buy it? Well, I mean, what's that? Hundreds of dollars higher? Thousands of dollars higher? Depends on how deep the hole is. To me, I think it's time. It would suit them very well to have a gold revaluation.
Well, there's a lot of things to unpack there, Andy.
Yeah, I know,
Plus
but
the fact
you're the man.
Plus, you slipped in a little raison d'etre in there just to show what a Renaissance man you are. I caught that. Anyway, I start maybe with the central bank stuff because and then we'll get to the revaluation in a minute because I think they've been dropping hints on that for over a year. And because I want to ask you about it because I watched in March, and anybody can go back and just pull up a chart. Spot price probably works best. You go back between the 18th, the morning of the 18th, which I think was a Wednesday, and the morning of the 23rd, which was a Monday. And there were 3-hour periods each day during London trading hours, like 6 a.m. US, 1 a.m. US, where the price just collapsed. If you add the 4 days together, total about 12 hours, gold fell $1,000 in 4 days. Now people say, okay, well, not a safe haven. Okay, well, if you put that $1,000 back on, gold would basically be unchanged since this war thing began. And to what do we attribute that $1,000? To me, I don't know, Andy, you were watching it every day. I thought that's when Turkey was dumping their 100 metric tons that they dumped in March. I thought that was maybe the footprints because, they've come out now and everybody said, oh, Turkey dropped, whatever the total was, and they've been slowly buying it back. And they've done this. They did this back in 2023 when there was the currency crisis. They unloaded a whole bunch of gold. And then what they do over the next 2 years, they bought it back. Mm-hmm. So now they dumped their 100 metric tons in March. Gold lost $1,000 in price that it hasn't regained. But the rest of the central banks have continued to buy. Turkey's going to be coming back now, especially now that the war's over, to try to rebuild or unswap or whatever they did and rebuild their reserves. Andy, China all last year bought 27 metric tons officially. In the last 3 months, they bought 24. So none of this whole central bank demand story is unchanged. It's actually accelerating. And yet everybody's trying to make, downplay it. Oh yeah, gold's going to 2000, don't you know? Because I read the waves and, and counter. Did you see, what have you seen? Do you think I'm right? This thing in March where gold was just plunging 4 days in a row to a washout. And have you sensed, what kind of demand are you sensing? And what are you hearing out of London? Is it returning?
Well, I think, I think what we're seeing here is, yes, you mentioned Turkey selling central bank gold. Two things there. First thing, it says gold is the safe haven reserve asset that you can cash in to repair a problem instantaneously.
Right.
No discussion. It is the supreme hedge. So if you need dollars in a hurry because of this war situation and you were short of dollars, you had to do it. But my understanding is they leased it to the PBOC. They leased it, and essentially every single time we've seen this since the last official gold sale from the World Gold Council, or the official gold sale, that is always been a central bank to a central bank transaction. Always. It never actually hits the market. Never. Only when Gordon Brown wanted the price of gold lower, as opposed to let's try and get the best price for UK gold, was it pre-announced? Was it actually then shoved into the market? Since then, no central bank has actually put their gold into the market.
The March drop can be read as a liquidity event rather than proof that gold lost its safe haven status. A central bank needing dollars may lease or mobilize bullion during stress, but that does not erase the larger buying trend. The important detail is that official demand appears to be returning rather than disappearing. If leased metal must be replaced, the same institutions that used gold for emergency liquidity may become buyers again, especially before prices rise further. That creates a quiet floor beneath the market. Paper selling and options leverage can still produce sharp declines, but physical buyers are likely to treat those breaks as chances to secure supply. The result may be a market that looks weak on screens while becoming tighter underneath, with future rallies moving faster once short-term pressure fades and confidence returns to bullion more broadly. Now, let's get back to the interview.
I saw, obviously from a physical market perspective, we reached 5,000 solid physical support. Unfortunately, the likes of Jane Street and these other guys, options guys, they've learned the cartel game to a degree where in 6 days, they literally raised the price of gold by about $600. They went like from 5,000 to 5,600. Right. This is initially.
Mm-hmm.
Then they pull the plug. Now, in the meantime, you get like four margin calls in a row. They pop that bubble. So now I honestly believe that they've turned gold into a meme stock situation. These idiots, and what they've done is taken what is a physical marketplace, and whereas we've lost all this open interest, these guys come in and write options. I mean, you get carried out feet first if you're wrong with you write these options. You're seriously, it's not just 100 to 1 leverage, it's 150, it's 200 to 1 leverage. And so I honestly believe that these guys actually then reacted to the margin calls and then pulled the plug, and literally it started the whole downfall. And then in the meantime, coordinated with that, yes, we have central banks saying, hang on, I need some dollars. So you kind of all this concatenation going on. And I think you're right. But I honestly don't think any of that central bank hit the actual market.
Actually hit
the market at all.
They're going to want it back. I mean,
of course they want it back.
Yeah.
They leased it out. They leased it to get the money. And it's like, they're going to buy it back. And if they do it soon, not that much below where they actually, and they don't want to buy it back later. It's going to be very, very expensive.
Right.
So I think there's an incentive, as you say, to buy it all back now. And any other central bank and some of the smaller central banks needed dollars, especially you need dollars when the oil price going up to potentially $200. I mean, what do? You need dollars in a hurry, right? So what do? You cash in. And we've also seen when the stock market started to pummel, you also see people cashing in the only viable hedge they had, which was gold. One day, and we talk about revaluation, one day it's inevitable. I know we've talked about it for years, but is there ever a better time? Now that every central bank is asking for their gold back and they're going to come knocking on your door, is there ever a better time to actually patch that up? Well, you ain't going to go to the market to buy it. So why would you not just do a keystroke entry, gold revaluation account,
Right.
bang, we're sorted. Now we want a higher gold price, like the PBOC do, like every other central bank, like the Bank of International Settlements do. We all want a steady rising gold price because actually it is a really good collateralizable asset. So just think, if it's going to happen, Craig, and we talked about it in the past, there's only one way this could happen. It'll be the opposite of what Gordon Brown did. They will mark the price to market on a Friday.
Mm-hmm.
On Monday, there will be a wholly different price. You'll be locked in to your position. But if you're short on the COMEX and you get caught in that weekend position and you wrote options against gold or silver at that point, you'll be carried out feet first, instantaneously. And I think there's the danger and a warning for these guys who are actually helping to destroy the COMEX. So thank you for that, because really you're just making it into such a volatile environment that all the good guys have gone. So essentially, one of these days they're going to wake up and they'll be actually on a cart on the way out the door. It is that serious. It's going to happen that way. No way will anyone, the House will know, and everyone in the know will know what's happening. And it'll just happen over a weekend. And you will be looking at your positions. Now, if you're long COMEX, no problem. I mean, why would they block you? If you're hedged in the T+1 NSFR compliant markets, well, okay, you're hedged. But if you're unhedged, if you're naked short, you're dead in the water. They'll throw you under the bus, just like any other card counter in a casino, under the bus.
Do you think they just would cash if that were to happen? And again, and here's the other part of this question, Andy.
Yeah.
Is say the U.S. revalues it at, just pick a round number, $10,000 an ounce. Could be $20,000 an ounce, whatever, because they look at it as deficit neutral free cash. That doesn't necessarily mean that gold has to trade at $10,000 or $20,000 an ounce the next Monday. I mean, it's an accounting error, but you would just suspect that it would, right? It would be like, oh, hey, I mean, I don't know how high. So anyway, in that scenario, do you think they just call it a day? They just say, you know what, in working with the CME, we're going to cash settle all these contracts out at whatever the closing price was back on Friday. And going forward, there are no more gold futures. Because, I mean, you've somebody that's short even 10 contracts and the price goes up sixfold overnight. They don't have that money. Their clearing firm doesn't have that. Nobody would be able to make that margin call. I just wonder, I don't know, this is all kind of
The most powerful prediction is a possible official revaluation. If authorities decide that existing gold reserves can strengthen balance sheets without issuing new debt, a higher accounting price could arrive suddenly rather than through a slow public process. A Friday to Monday reset poses a risk. Markets close with one reference price and reopen at a much higher official level. Numbers such as $10,000 or $20,000 an ounce are not guaranteed trading targets, but they show the scale of repricing that becomes possible when gold is treated as monetary collateral instead of just a commodity. In that event, unhedged shorts, heavily leveraged options writers, and weak clearing links could face margin demands they can't meet. Cash settlement or a redesign of futures trading would become plausible if the paper structure cannot absorb the shock. Even without a formal reset, the long-term path still points higher. As currencies expand and central banks compete for physical metal, a move toward $9,000 for gold within several years becomes a realistic outcome. The near-term volatility may feel severe, but the bigger signal is scarcity meeting policy pressure, which favors patient holders. The dips matter, but the ownership of available metal matters even more over the next market cycle. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.